There are so many predictions about what's going to lead to property price growth in the future. But today, with Pete Wargent, I'm going to explain to you a demographic tsunami that is going to change our property markets, and one that you really must understand if you want to own the sort of property that's going to outperform in the future. I'm also going to discuss with you 7 signs of a shonky property guru. This came from a game I played on the weekend. I'll explain that to you shortly. And in my mindset moment, I'm going to explain to you why being rich is a choice. So you have a choice. If you want to be, you can become rich, and I'll explain how. So welcome to another episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
There's no shortage of housing forecasts at present, and many of them are a bit scary. And what this means is that many investors are making decisions based on the media, on the last 30 minutes of news. They're making 30-year decisions and not on the fundamentals. But there's one big driver, a veritable tsunami that property pessimists seem to have forgotten. Now, it's not our economic growth and it's not jobs growth. It's a demographic tsunami that's going to hit us, according to Pete Wargent. Now, if you haven't come across Pete before, he's a chartered accountant, a chartered secretary. He's got a financial planning diploma, but he's really a very prolific author with a number of books under his belt and a great daily blog, and regularly writes for Property Update. So welcome, Pete.
Pleasure, Michael.
Now, I know you've actually used a long-term approach to property investing to build your own wealth, so that you're now roaming the world and having a lot of fun with financial independence. But I remember reading in one of your recent blogs about a demographic tsunami. Now, we both know that demographics is one of the major factors that's going to affect our property market over the long term, much more than changes of government or changes in interest rate or bank lending. What's this big hidden tsunami that's going to overcome us?
Yeah, so mostly what you see that gets reported on population growth, it's usually just a headline figure. So I saw the budget papers were out just the other day, and they, despite all the talk about tinkering with population and migration programs, still very high assumptions for population growth. But I think if you're interested in real estate, you need to drill down a level or two from there. So we know this in Australia, particularly Sydney, Melbourne and southeast Queensland mopping up the big chunk of that population growth. So that's tracking at about 400,000 or so per annum. But the thing that stood out to me from the census is that because Australia's visa programs are very much tilted towards the under 30, so in fact, including people like myself when I was still in my 30s, is that we've got this enormous surge of people in the 25 to 34-year-old age bracket, which today is increasingly the typical first home buyer age. So now it's different by city. So it's particularly relevant to Sydney and Melbourne, where you've got about half the population in these younger age brackets in the inner suburbs. So it's just this massive surge, and it's unprecedented. So yes, at the headline level, lots of people coming to Australia, that's one thing, but it's just this monster surge in housing market demand that's on its way.
Well, it's interesting because population growth is important, but really more important is household formation. So therefore, we want to understand how many new households are being formed and what sort of accommodation they're going to want and where they're going to want to live. So for many generations, it was really the baby boomers that drove our property markets, because there were a lot more baby boomers, people my age, than the generations before us. So they had to build more kindergartens and then schools and then universities and I guess now nursing homes to accommodate us. So what are the requirements going to be for this next generation that's going to drive our property markets?
Yeah, you touched on the key point, and that's working out, well, where do all these 25 to 34-year-olds, where are they going to buy? Because a lot of these are going to be first home buyers. Now, in an ideal world, we'd all own massive blocks of land close to the city, but the reality is that first home buyers, which many of these people will be, they're going to be starting with apartments. And what the demographics are showing, and I should give a hat tip to Simone Alexander, who's done drilled down into the detail on this much more than I have, but it shows that people are generally congregating, the younger people, in the inner suburbs of especially Sydney and Melbourne. So I think the type of property that they want is not likely to be the high-rise apartment towers. What people really want is something that feels like a home, but it's probably increasingly on a body corporate or a strata.
Well, that's interesting because a lot of people are calling this the missing middle. So there's a huge number of cranes in our cities building those monolith high-rise towers out of paper mache, we're now finding out. And that's probably not the sort of building that you want to live in or own. And then there's all the new estates way out where there isn't as much infrastructure and as easy transport. But in the middle is where a lot of people are going to want to live. A lot of these younger people are going to want to live in modern accommodation that gives them a sense of presence. They're close to the amenities, they're close to their lifestyle, but they don't want to be in those big monoliths, Pete.
No, that's right. And in fact, this is quite timely because the ABS has just put out some really interesting stats on what's happened to the type of accommodation that's been built over the last 15 years. I mean, we all kind of knew this was happening, but the average floor area of new apartments has just nosedived by about, nearly 20% over 15 years. So we used to build a lot of stuff with good space and accommodation, but increasingly lots of high-rise towers. So I know that we've had slightly different approaches because we're at different stages in our journey. So through necessity, when I started out, I was just picking off individual units because that's all I could afford to do. I know yourself, you developed lots of townhouse-style properties and that kind of accommodation. I think that's more really what people want, some stuff that feels more like a home. Sometimes it's more family appropriate, and you've got a bit more space. And there's always going to be certain features that's going to appeal to an owner-occupier, and I think that's what you've got to look for.
Well, apartments that are built for families are what we require more, but it's actually not as profitable to build. So yes, what we are building personally and for a lot of our clients at Metropole that they keep as long-term investments are townhouses, which are modern accommodation on compact blocks where you pull down an old house in a good location with good amenities and good shopping and good schools. And in fact, the last census, as you know, Pete, showed that there was an 11% increase in our population living in townhouses. But most developers are trying to cram as many apartments as they can on a small block of land, and they're not investment grade properties. But if we built more apartments that would accommodate young families and older families, wouldn't that be good?
Yes, and I think these things go in a cycle, as you know. We've come through. I mean, you could particularly see it in the period from 2011-12 onwards. There was a lot of stuff that was built for non-resident investors, bought out of a brochure, but that's really slowed down now. And in fact, the latest stats showed that the cranes are increasingly coming down, partly because there are fewer non-resident investors in the market now, but also it's just that stage in the cycle. So we're seeing the absorption of all that new apartment stock, and that's what sets up the next housing market cycle.
So as a property investor, we know that owner-occupiers drive the markets and investors create the booms in between every now and then. So if we want to buy the sort of property that's going to outperform in the long term, what are the trends that are going to drive property values up over the next decade?
Well, we talked about the headline population growth already. So the budget forecasts show that Australia is probably heading towards a population of about 30 million over the next decade, from just over 25 today. So it's a massive amount of new accommodation that we need. But something that that the importance of this has only really come to me in recent years, something I learned from you, Michael, is the importance of locations that have got that supply-demand imbalance that just continue to make them outperformers. Because if you've got landlocked areas where people want to live, they're close to amenities and transport and all of that stuff. Well, if there's only a finite amount of land and there's all these millions of people immigrating to Australia, plus the natural increase in the population, that's the main driver. So the average cost of actually building property has gone up a lot too over the last 15 years, the ABS showed. But I think if you want to really outperform, you've got to buy in areas where the land is finite, and that's it's that supply-demand imbalance that drives the growth.
So land is in short supply, and the type of accommodation that you're owning is in short supply also. So if the land has been rezoned and all of a sudden there can be lots of high-rise towers, that also is going to mess up the supply-demand ratio. So we also look for municipalities where development is occurring, because we like the areas to gentrify, but we're not wanting to buy in those new developments. We'd like to be a little bit away. So in Melbourne, where I do a lot of my investing, down most of the main roads, the councils allow people to build 2 and 3 stories above shops now. So you'll see around transport nodes along main roads, lots of new apartment developments. We don't buy in those. We actually go back a couple of 100 metres into the side streets. And it's really good because the shops have improved. There's a lot more population there. The local areas have become more vibrant. We allow those people living in those apartments to make the areas more viable for the shop owners, have more amenity. But we just want to be far enough away, but not too close, Pete.
Well, that's exactly it. And an interesting trend to watch out for is the rise of electric vehicles. And I know some people say, well, in that case, we should buy in a main road because they're not highly sought after today, but they could be quieter in the future. But the thing is, they'll still be busy. So ideally, the types of streets that people actually want to live on rather than buy as an investor, they're usually just usually set back a little way. So they're still just pleasant places to live, but close enough to the action, good walk scores and so on.
No doubt that the sort of transport we're going to use is going to be different in the future, whether they're electric cars, whether they're jointly owned cars. But as you said, our population is going to increase by 20% over the next decade. Where are we going to put 10, 20% more cars on our road, Pete? So therefore, walkability, easy access to public transport, in my mind, is also going to be pretty important.
Hugely, yeah. And as you know, I'm sure I've mentioned this on a podcast previously, is that it's something we learned in London way back 10, 15 years ago, is that properties that are located within a 5 or 6 minute walk of a tube station, automatically 25% premium, because nobody in London really wants to drive anymore. And that's what a mature capital city is like. Now, Sydney's about 5.3 million today. The way things are going, Melbourne's going to overtake Sydney from a population perspective over the next decade. So they're becoming those mature capital cities where people will want access, particularly, I think, to train and transport nodes, as you mentioned.
Well, the lesson from this chat to me is we have to become a student of demographics. And I know you put out a blog every day. And so if people want to follow your blogs, where should they go?
The easiest place to find me is just my name, petewargent.com. My daily blog is Pete Wargent Blogspot.
And of course, you regularly write for Property Update as well. Thanks a lot, Pete. And I look forward to having you on another podcast real soon.
Always a pleasure. Thanks, Michael.
I'll be back in just a moment with 2 important segments. The first one is explaining to you how being rich is a choice in my regular mindset moment. And then I'm going to explain to you 7 signs of a shonky property guru. And this came about from a game I played a short while ago with a friend. You'll understand what I'm on about, and you'll understand how to protect yourself from bad advice. So I'll see you just after this short break.
If you're unsure what to do next in our changing property markets, why not turn to the proven and trusted team at Metropole Property Strategists to take advantage of their expertise of profitably investing through the last 5 property cycles. The team at Metropole have been involved in over $3 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development, or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au. Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Believe it or not, being wealthy is a choice. Now, I'm not sure that when I first read this, I really understood it. But when I did get the power of that statement, it made a big difference to me. Look, I probably read it in a book like probably one of Rob Kiyosaki's books. However, I do remember thinking, that can't be true. It's not that simple. You can't just choose to be rich. But then over the years, as I learned from my mentors, and then I also studied the psychology of success, I discovered that Kiyosaki was actually right, and I was wrong. Yes, being wealthy is a choice. Over the years, I've learned that becoming rich begins with something as simple as the thoughts that you put in your head. Wallace Wattles first wrote about it in The Science of Getting Rich, and T. Harv Ekers tweaked the words a bit in his book Secrets to the Millionaire Minds. But they both taught me that your thoughts lead to your feelings lead to your actions, and your actions lead to your results. I'll repeat that again because it's important, because your inside world controls your outside world. Your thoughts lead to your feelings lead to your actions, and your actions lead to results. Of course, your thoughts are reflected in the vocabulary that you choose to use. So I've heard others put it this way: your thoughts become your words become your actions become your habits, and your habits become you. Because the words you use, the ones you use out loud, and the words you have in your head, the little voice inside your head, they're pivotal points between the thoughts and your actions. The words that you use have a surprisingly profound impact on how much wealth you obtain. So I'd like to just go through 5 scarcity mindset phrases that I hear people use, and I'm also going to explain to you some abundant mindset phrases you could use instead. Because if you tend to use scarcity vocabulary, it's going to be nearly impossible for you to obtain real wealth. So let's run a little check on the words you use. Which of the following you're more likely to say or to think to yourself? Number 1, the scarcity one is, I want to be debt-free. The abundance mentality is, I want to be financially free. You see, no one shrinks their way to wealth. No one ever got rich paying off their mortgage or paying off their car. So being debt-free isn't the answer. On the other hand, those who embraced good debt and used leverage to buy income-producing growth assets like residential real estate, they're the ones that developed financial freedom. Okay, the set of statements number 2. The scarcity statement says, live below your means. The abundant way of thinking is, expand your means. Now, I understand why people say live below your means. Sure, you must spend less than you earn, otherwise you're always going to be in debt. But the point of becoming wealthy is to live an abundant life and to be able to enjoy the good things in life, including giving back to your family and giving back to the community. So rather than living within your means, why not expand your means? Focus on production, not on reduction. Okay, scarcity statements number 3. I must work hard, or something like I must even make my money work harder for me. But the abundant way of looking at it is I must make other people's money work hard for me. It can be a stunning revelation for you to learn that getting your money to work for you will not create wealth. You just can't save your way to wealth. Instead, ethically employing the money of other people, of your tenants, of the government, of the banks, and now you have suddenly the ingredients for true wealth creation by using compounding and leverage. Let's look at another set of statements. One of them, the scarcity statement first, and then the abundance statement. The scarcity statement says, compound interest is magical. I'm sure you've heard that before, but abundant people think differently. Leverage is magical. As I said, you can't save your way to wealth. Even at a reasonable rate of return, compound interest only has a chance of providing you an adequate retirement when you get older, but it'll never give you real wealth. On the other hand, leveraging, using other people's money, gives you the return on investment from their capital working for you, not just yours. And this last set of statements I'd like to have a look at, let's build a budget and stick to it, while the abundance statement would be, let's make a cash flow statement. You see, to me, the word budget implies, I don't know, frugality, scrimping, saving, cutting back. You can only cut back so much of your spending, and then you end up living a life that degrades the quality that you deserve. And it gives you a lifestyle time wasted you'll never get back. Instead of sticking to a budget, I'd be suggesting you build a property investment portfolio that'll increase your asset base and in time deliver you multiple streams of income. That's going to increase your income potential, isn't it? Scarcity or abundance begins with your thoughts, begins with your words. So which life do you really want to design for yourself? One of scarcity or one of abundance? As I stated right at the beginning, you do actually have a choice if you want to become wealthy. Let me leave you with the last statement. A rich man digs for gold, while a poor man is concerned with the cost of the shovel. I played an interesting game over the weekend. We had some friends over. They came down from Queensland, and I played this game called Where Are They Now? You see, I sat down with a friend who's been a real estate educator almost as long as I have, and we pulled out some old copies of Australian Property Investor magazine dating back almost 20 years. Now, of course, they've stopped printing Australian Property Investor magazine, but what we did was we looked at the so-called gurus who offered advice, who took out the big ads, who were featured in the magazine over the years, and we wondered, where are they now? Now, in the interest of full disclosure and transparency, you know it. I'm a property professional who's written 8 books, published more educational articles than anyone else in Australia. I hope you know my Property Update blog's been voted the #1 real estate website in the world in 2017 and 18. We'll see how it goes this year. And my podcast that you're listening to now ranks amongst Australia's top Australian investment podcasts on iTunes. So clearly, I believe in the value of education. I believe in the value of mentoring to help increase the chances of success in property. So I'm not knocking people who are out there educating. And there are many other very good professionals in this industry. But it hurts my industry when naive investors fall for shonky real estate gurus. And boy, has there been a continual conveyor belt of gurus that have come and gone and along the way taken innocent investors' money and misleading them to invest in the wrong sort of properties, and often with disastrous financial results. So yeah, we played this game, Where Are They Now? And I guess shared some interesting stories. So today I'd like to share with you 7 signs that your real estate investment guru, the one you're choosing, may be shonky, and maybe you should look into it a bit further. So the #1 thing was that they tend to brag about their achievements and talk themselves up. Many of those failed gurus, they featured photos in their ads and in their books with themselves in front of nice cars, and often they were red sports cars. Now again, a disclosure, I've always owned nice cars, or I have for many, many years. But you don't know what my car is. You don't know what Pam's car is, do you? I don't show it off. The minute a guru starts mentioning how successful they are, how wealthy they are, how happy they are, my alarm bells tend to go off. Another common trait of these failed gurus were that they claimed their secret techniques could work for anyone. And of course the secret is there are no secrets. There are simply too many factors involved in success of any kind. So avoid those gurus whose offers appear in your inbox that claim to reveal the insider secrets, or only to a select few, or I'm going to pull back the curtain. Of course, you usually have to buy an expensive course or something like that in order to find out what those secrets are. The third warning that the person who's wanting to offer you advice may not be as legit as you think is they don't warn you about the risks or the possibility of failure. You know it yourself, all investments come with an element of risk. So when you're told this is a guaranteed method, run in the other direction and run fast. There's no sure thing. So a property advisor is also going to let you know about the risks, and they're going to tell you that properties go down in value over a cycle and can cause ups and downs. They're going to recommend risk mitigation strategies such as the right ownership structures, having the right finance strategy, having a financial buffer in place, getting yourself insured, getting your properties insured, having the correct asset allocation and selection. The fourth sign of a potentially shonky advisor is that they say you can get involved with property with little or no money. Now, even if you could buy with no money down, the big problem is that you haven't yet developed the money skills to save a deposit. If you haven't got financial discipline, if you're not financially fluent, then you shouldn't take on the financial commitment of property investment. And to recommend that you do so, in my mind, is irresponsible. Fifth sign of somebody you should watch out for is that their testimonials sound too good to be true. Look, you know what they say. If it sounds too good to be true, it probably is. And over the years, many of the so-called gurus that we were reading about in those magazines over the weekend have been taken to task by ASIC for making false claims about their students' success. Another thing to watch out for is that they pretend to be mentors when in fact their aim is to sell you property. Now, I strongly believe in the benefit of mentors. I still have business coaches. I still have mentors in many areas of my life. And personally, I've mentored over 2,500 people in the last 12 years through my mentorship program. Now, of course, this is the point where lots of people are going to say, look, even Tiger Woods has got a coach. Or they say things like, you can read a lot about flying a plane in books, but you probably want a coach there the first time you go up. So yes, you do need mentors. And some of your mentors will be virtual. You know, you just only read their books. You may never meet them. You may read their blogs, you listen to their podcasts. But in my mind, to get the best out of a mentor, you need to pay for their time to give you personalised and individual advice. But it's the shonky mentors who couch their property marketing activities as mentorship programs. They're the ones that I'm suggesting you avoid. And the seventh tip to watch out for is when people suggest you can amass a large number of properties in a short period of time. Look, you've heard the claims, I don't know, 7 properties in 7 minutes, 10 properties in 10 years, I don't know. While they may sound tempting to beginning investors, it's just too hard to build a significant portfolio of investment-grade properties, of good properties, quickly. I've seen too many failed investors buy a number of secondary properties in cheap locations, and then they get stuck with these underperforming properties. And I'm not just talking about those who got caught in the mining downturn and the mining boom, but others who just got stuck in underperforming locations and their properties sucked up their money, and worse still, they couldn't sell up without making a loss if they could sell at all. So I guess my message today is there are some great professionals out there who provide real education for property investors. Don't get me wrong, I believe education is extremely important for investors, but simply be wary of the smooth-talking real estate gurus with promises that sound too good to be true. So do your research and be very careful who you take advice from. We discussed a lot today. I hope you got something out of the show. And if you did, please tell somebody about it, because my aim is to make as many people financially independent by educating them about property, investment and success. And boy, did we cover a range of topics today. So thanks, Pete Wargent, who I'll have back again real soon. Now, I love getting the reviews that you're leaving me. And if I read your review out, I'm going to gift you one of my books. All you have to do is email me, michael@metropole.com.au, when you hear your name called out. And this week it's Jessie Nerdy. So Jessie said, Michael's knowledge about property and investment is beyond anyone that I've listened to on podcasts. His advice and suggestions are unbiased, which is so difficult to find these days. He's not just a businessman, he's like a mentor for business-minded people who want success in life. Well, thank you so much. And if you email me, I'll be more than happy to gift you one of my books. And I'm doing a series of podcasts for business people as well, because I know a lot of people who get these shows also are in businesses or professions or are entrepreneurs and want to become business people. So watch out for the monthly Build a Business, Not a Job podcast. And in between these shows, which I'm now bringing you twice a week, if you want more information about money, success, property, go to propertyupdate.com.au, my website that last year was visited by over 1.1 million readers. It's been voted the #1 property blog in the world. Please go along, subscribe to my daily newsletter. I'd love to show you what I'm thinking about property, about money, about finance, about economics each day in your inbox. Look forward to catching up with you again real soon.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?